All right, we're going to go back into inventory. This time we're going to look specifically into inventory. So just like I told you in chapter 4, we're going to be taking bits and pieces of what we talked about in 1 through 3 and kind of expanding our knowledge on it. This one we're going to be specifically talking about inventory and how do we deal with inventory, different methods in which we deal with inventory. So let's jump into this. We know inventory to be all goods and that a company owns and controls or holds for sale. That makes it an asset. And again, the intent is to sell. Now, there are certain things that we have to pay attention to when it comes to inventory, because inventory in our books, merchandise inventory in our books, is not specifically just inventory. There's also other things that we have to deal with that would affect inventory. So one would be goods in transit. We talked about that before when we talked about FOB shipping point. That is the buyer's responsibility. And if it is our responsibility because we're the buyer, then we're just going to add that into the inventory. So again, if the ownership has passed through to the purchaser, the goods are included in the purchase inventory. That's why we debit the inventory account. So that's one thing that would affect the inventory account that is not specifically physical inventory. Another thing that we need to pay attention to are goods on consignment. You know, when you're dealing with goods on consignment, you need to really understand who needs to keep the inventory on their books as inventory, the products. Is it the person who is selling it, or is it the person who owns it that they're getting somebody else to sell it for them? So these are goods shipped by the owner, which is the consignor, to another party, which is the consignee. The consignee sells the goods for the consignor, and the consignor is the one that owns the consigned goods and reports the inventory until they're sold. So yes, the consignor is the one who owns it. They can control it. They're the ones that says, hey, I don't want you to sign that. They still own it. The consignee is one that's just simply facilitating the sale. The consignee doesn't keep it on their books. Think of it much like an auction site on the web, the internet. They're just facilitating the sale. They're not the ones that actually own and control the inventory. You, as the one who puts that on the internet site, is the one that owns it, so you would still maintain control and have it on your balance sheet as inventory. One other thing we talked about already too is goods damaged or obsolete. Again, we need to make sure that what we have on our shelves or what we say we have is what's also in our books. So the damaged and obsolete goods are not counted as inventory if we can't sell them. Again, if the intent's not there to sell, if we can't sell them, we can't claim them as inventory. Unless if the goods can be sold at a reduced price, they are included in inventory, but at their net realizable value. We'll talk a little bit. Net realizable value is a term that we use a lot throughout accounting because it's a very broad word. Net meaning total, realizable meaning cash value. So net realizable value means total cash value. We use this multiple times through accounting, so you're going to hear me say that again. We'll talk about that a little bit later on. But that's everything that we need to keep up with before we jump into what really this chapter is about and how do we handle inventory. So appreciate it.